Wagner from True Peril, and I have Murat Dorkan with me. And today, Murat, we're testing this out. So we'll end up posting this video in a little while after we maybe do a little bit of editing. And so tell us a little bit about your background, Murat.
Well, I've been in the financial services industry for 29 years, almost 30. I was part of an organization, a financial house, if you will, Penn Mutual, for a long time. And I realized, and very quickly, and my partners as well, the difference between being independent and perceived to be independent. And in 2010, we went out on our own. And we're aligned with Crump Advisory, which is the largest independent financial brokerage in the country that services all the financial names of institutions that we all know, like Mass Mutual, Penn Mutual, Merrill Lynch. The independent platform turnkey outlet is Crump, but their clients are those institutions. And fortunately, after 18 years with them, we were able to stay independent with them. And we are independent with them today and are able to provide all of our clients access to any carrier they would possibly want to buy from, and have a list of carriers and products that you should stay away from like the plague. And that independence is truly valued by our clients.
That's awesome. Well, thanks for sharing that part. And a couple of weeks ago, you were in front of a group that I happened to see you present. Part of what your planning strategies are for long-term care is what you were covering that particular day. So I'd like to, if you take a couple of minutes and just kind of rehash that for our viewers as to some of the highlights from that particular presentation.
Sure. Yeah, in that presentation, the highlights are pretty, there's a couple things. Long-term care applies to every human being on the planet. Nobody ever needing, whether they're 30 years old as a result of an accident or an illness, or their old age and it's dementia and it's just difficulty walking, whatever. Whenever you need assistance in activities of daily living, there's 6 of them: bathing, feeding, dressing, toileting, transferring incontinence, or any cognitive impairment. You're going to have a situation where after the first 90 days, health insurance, Medicare, nothing is going to pay for that except for each of our pockets, including my own. So if you are a person that has $50 million or $20 million and you only have an income need of living your retirement life of $100,000, then you can probably say that you can self-insure for something like this. But for the majority of the people in the United States, we spend so much time retirement planning, saying, for example, Al, you want to retire at age 65. How much money do you need to get the sufficient income with Social Security to hit you $80,000 or $100,000 or $150,000 or whatever it is a year during your retirement? And we can calculate those numbers and maximize your savings and tax strategies to get you there in the most efficient way possible, using your work plans and supplemental plans to get you there. But the problem is we all retire one day. And having just put my mom in assisted living, and being late to sign on to this webinar as a result of it because she slipped, I've not only do I own long-term care, but I've witnessed it firsthand that my mom's at the level 1 level of care. It's $5,100 a month. It's going to be going up. That's after taxes. So in the example I just gave you, if your retirement income, let's use easy math, is $100,000 and you've spent the last 10 years with your advisor that manages your money and charges you 1%, so that he tells you he or she tells you you're going to have enough money to retire, it's complete malpractice if you haven't addressed long-term care, because I can tell you, if you have to pay $5,100 or $60-some thousand a year, you got to take out $90,000 from your retirement money, pay income taxes to get the $60,000 to pay the long-term care bill, and the spouse that's still healthy hasn't even bought bread yet. So your retirement plan is flawed, and you might as well consider it defective and handicapped. All you've done is accumulate a nest egg that someone else is going to soon own, because 1.75 out of 2 people over age 65 are collecting on long-term care. We're all living longer, and sooner or later we're going to need it. And when I walked in, they said, let me see your mom's balance sheet. I'm the power of attorney. Let me see your statement. Let me see your deed. Let me see everything. And then I'm like, well, wait a minute. We have long-term care, pays $12,000 a month up to that. and we're in good shape. So it's asset protection tools and the strategy to do that. And there's also tax deductibility for long-term care, and it can also be combined in a life insurance purchase decision if it makes sense. It's a client by client basis.
So Murat, you were mentioning that they wanted to see your mom's balance sheet, and that the other comment that you made in conjunction with that is that you've collected all this and then somebody else is going to own it. Can you expand on that a little bit? What do you mean by that?
Well, if you're an elderly person, you have a few options. You can either become a burden on your family and have your kids take care of you. And to use myself as an example, when my dad was a physician, when I was 9 years old, he had a massive stroke. He was a vegetable. He was a doctor. People operated on him that knew when they should have let him pass. I was wiping his butt. He was in the hospital for 3 years. And we, luckily had disability insurance to pay for it during that time. But if you don't have insurance or the wherewithal, you either take care of your family member in the house, take off work. 24-hour around-the-clock care, it becomes an enormous burden. If you want to maintain your dignity and integrity, nothing is going to pay for any of this stuff. So let's assume you own your house free and clear, and you have a nest egg of, I'm making up numbers, $500,000. If it's
Uh-oh. Looks like we lost Murat. There you are. Are you there?
Yeah, there was an Amber Alert that just popped up.
Oh, okay.
Yeah, not sure what for, but I just read it. Something in a different county. They will take your assets. What they will do is they will put a lien on your home, and as you accumulate, $60,000, $80,000, $150,000, $200,000 on your house, then at the time that house is sold and at your demise, and when it is sold, that lien will be exercised, and it'll either be exercised cordially with your family, or it'll be exercised on when the sale gets processed, they will take the money that's due them and subsequently reduce the inheritance that's going to anybody that you own. So until you're down to basically under $10,000 to get complex, you then Medicaid, the government can ship you off to one of the cheapest places to be cared for. But that means everything that you own, clothes, everything, house, cars, assets, retirement plans, savings accounts, everything is under $10,000. So if you can buy long-term care and do it cost effectively and have tax advantages incorporated in the purchase, it can protect your assets and give you peace of mind in your retirement. Another problem that's going on in Southwest Florida too that you should be aware of is there are over a few hundred products being sold that are not being sold in any other state. And it's a true fleecing of the Floridian elderly people, where you're paying for long-term care products. And I've seen a few of them already in the short period of time that I've been down here helping clients. And it's just not worth the paper it's written on. And it's a true shame, because at the time claim comes, you're going to find out real quick.
So basically, what people should be, one of the things they should take away from this, our short little time together, is if they're not going to do the planning necessary to protect themselves financially, they're actually going to end up fairly, I'm going to use the word destitute, and at the mercy of the Medicare system for wherever it is they're going to end up being placed, or they're going to end up being a burden on their family. Fair?
Correct.
Yeah.
Correct. Yeah.
So
and then not to mention if you are, have a significant other, whether it's a partner, if you're heterosexual, homosexual, whoever is important in your life that you're going to enjoy your retirement with, that person is not going to be able to do anything because you're drawing down the assets.
Right. And there's the key. It's all being drawn down little by little, or in bigger chunks. If it's $5,000 a month, that's not a small nut to crack every month.
Correct.
So awesome. Murat, if there was one or two things that you would like to leave the audience with as they're watching this and starting to really contemplate what the future holds for them, what advice, and I use that term very, very loosely because we all know what compliance means and all the rest, but what would you have people start to look at or start to think about doing after they watch this?
Well, if depending upon your age, if you buy it at age 30, I can show you math, long-term care protection. I can show you math that even if you keep it to age 80, the math works in your favor if when and if you collect. All those statistics are what they are over at 65 of who's collecting, as we talked about. So as far as getting it early, the misnomer of, oh, I'll just wait till I'm 55 to get it, not a good thing. Rates, the other thing, rates are increasing for new policies almost every single year, and they're going up anywhere from 8% to as high as 18%. So it's worth getting the coverage that you can afford as quickly as possible and making sure it's good coverage. Like I said, there's a lot of garbage being sold out there that's not worth. The baby boomer population is going through. It's a mass number of people, and there's a huge opportunity to be misguided. Crump Advisory, being the largest independent of top carriers in the world, much less the country, has sifted through all the companies, and if they don't represent them, pretty much you shouldn't own them. So it's pretty much as simple as that, as a general statement. Lastly, if you're working with a money management type advisor, their specialty is just that, to put you in mutual funds, charge you 1%, manage your money, and get you to the number that you're going to be able to retire on. And no disrespect to any of the people that do that for a living, but where their strength is in their asset protection side. Many times I'll talk to clients that have those people in their lives, and they haven't really even talked to them about proper life insurance planning, proper long-term care insurance planning. If you own a business exit strategies, business succession planning, how are you going to leave this business and get the equity out of it for your family, protect the assets from it for you? Are you just going to get stuck? Are you going to leave your spouse with a fire sale on the business and just not have a plan? Or just rely on a document that doesn't have any funding? So it would be that. And then the last thing is just protect your assets on the downside. We're in a very high marketplace right now. We have an election coming. We have tariff integration. So diversify your money, despite your money manager wanting to keep assets under management at 1% and charge you, 1% on the money under management. It's kind of prudent to diversify. There are programs out there that you could put money in that the downside risk is protected, and you have the upside potential, of the indexes with complete tax deferral. And there's really no reason you shouldn't diversify in that, other than your advisor telling you he doesn't want you to move 100,000 or 50,000 or 200,000 or $500,000, because he or she's going to lose selfishly the 1% on that money. So those would be the key points. Hopefully it helps.
Awesome. Well, we do have one viewer, and that happens to be Jessica. So she's kind of checking this out, and at some point she lost sound. So I'm not sure whether that's us or her. But other than that, if there's any, Jess, do you have any questions for Murat? And I don't think you've met Jess yet. Actually, she's my.
I have not. I've heard about her. You've told me about her, but I've not.
I talk a lot about her. So, all right. Well, I think we'll end the recording with this, and we can plan on some more and do figure out a little bit better give and take on this. And as a first shot, I appreciate you being the guinea pig and sharing the information, and we'll see where this goes.
Okay, well, sounds good, Al. Thank you for the opportunity. I wish you well, and I'm happy to do more and help you out as well.
Let's plan on it.
Okay.
All right. Thanks, Murat.
Take care, everyone.
All right. Bye.
Bye-bye.